Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Wednesday, March 18th, and we have a lot to cover today. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. Well, the dominant story right now is the anticipation around the Fed's interest rate decision later today. And markets are showing some interesting positioning ahead of that. We're seeing Bitcoin stalling right around that $76,000 level, struggling to break through 75,000 in resistance. And there's this palpable sense of caution among traders. What's particularly notable is this concept of sell the news risk that's emerging, where even if the Fed delivers what's expected, we could see some profit taking on the oil front. Brent crude is holding above $100 per barrel, which is keeping inflation concerns front and center. We've got some interesting analyst commentary with Jeff Curry from Carlisle saying oil is actually mispriced at these levels, suggesting there's more volatility to come. The equity markets are showing modest strength in pre-market trading, with futures extending yesterday's rally, but there's definitely a wait-and-see attitude developing. We're also seeing some corporate news flow with Macy's surprising to the upside on sales, proving Wall Street wrong again, and the stock is surging on that news. The broader theme here is selective strength, where certain pockets of the market are working while others are treading water ahead of Powell's comments.
That's a significant development with the Fed decision looming. How are you reading the market's interpretation of these mixed signals, particularly with oil elevated but equities still grinding higher?
It's a really interesting dynamic, Robert. The market seems to be compartmentalizing risk right now. On one hand, you've got oil at $100 plus, which historically would be a major headwind for equities because it raises input costs and threatens margins. But what we're seeing is investors focusing more on the Fed's potential pivot, or at least a less hawkish stance. The equity rally, even though it's modest, suggests that traders are pricing in a scenario where the Fed acknowledges the oil shock but doesn't overreact with overly aggressive policy. Now, the risk here is if Powell comes out and signals that persistent oil prices at these levels will require a more hawkish response. That could quickly unwind this optimism. From a trading perspective, I'm watching those key technical levels closely. Bitcoin at 75,000 is critical, because if it breaks convincingly above that, we could see momentum buyers come back in. But if it fails and we get a hawkish Fed, that 70,000 support level becomes absolutely crucial. In equities, the selectivity is key. Companies that can pass through higher input costs, like we're seeing with some retailers, are getting rewarded. But margin-sensitive sectors could face pressure if oil stays elevated. The positioning ahead of the Fed suggests most traders are leaning cautiously optimistic, but with tight stops ready to reverse quickly if the narrative changes.
That selectivity is going to be key in this environment. Steve, let's get into the economic numbers. What's the picture looking like this week?
Thanks, Robert. Earlier this week, we saw industrial production data released on Monday, March 16th, and it came in at 1.4%, which was down from the previous reading of 2.33%. That deceleration in industrial output is worth noting because it suggests some cooling in the manufacturing sector, though we're still seeing positive growth overall. Now turning to today's releases, we have two important indicators coming out. The producer price index is the headline number everyone's watching, especially given the elevated oil prices we've been discussing. The forecast for PPI is 0.2%, down from the previous reading of 0.3%. This is a critical inflation gauge because it measures the average change in selling prices received by domestic producers. And with oil above $100, there's real risk this number could come in hotter than expected. If we see PPI exceed that 0.2% forecast, it's going to reinforce concerns about sticky inflation and could influence the Fed's tone this afternoon. We're also getting factory orders data today with a forecast of 0.1% compared to the previous reading of 0.7%. That's a notable deceleration in new orders for manufactured goods, and it ties into that industrial production slowdown we saw earlier in the week. Factory orders affects the industrial sector primarily, and a weaker than expected reading could signal softening demand in the manufacturing economy. Looking ahead to tomorrow, Thursday the 19th, we'll get initial jobless claims which will give us a fresh read on the labor market. That's always a key indicator for Fed policy, because employment remains one of their dual mandates. The combination of today's inflation data through PPI and tomorrow's employment signal through jobless claims will give us a clearer picture of whether the economy is cooling at the pace the Fed wants to see.
Those are some important data points to watch, especially with the Fed meeting today. Lizzie, let's shift our focus to the stock of the day. We're looking at Rocket Lab Corporation. What's your analysis here?
Rocket Lab is a really compelling story right now, Robert. This is a company that's had an absolutely explosive run. Up 337% over the past year, going from around $18 to the current price of $78.59. They're a vertically integrated aerospace company focused on small satellite launches through their Electron rocket, and they've also built out a space systems business that includes spacecraft design and components. What caught my attention today is that the stock jumped over 10% on Tuesday ahead of back-to-back mission launches, their 84th and 85th missions, which really demonstrates the market's enthusiasm around their operational tempo. Now, here's where it gets interesting from a valuation perspective. The stock is currently trading at what I would characterize as extremely expensive levels. We're looking at a forward price to earnings ratio of 595, which tells you the company is barely profitable or still scaling toward profitability. The price to book is 24.81, which is 10 to 20 times what you'd see in a typical industrial company. The market cap has reached $44.6 billion for a company that's still in growth mode. Year to date, the stock is up only 3.4%, which suggests we're in a consolidation phase after that massive run up last year. The stock hit a 52-week high of 99.58 before pulling back, and we're currently about 21% below that peak. Analyst consensus is interesting here, with 12 analysts covering the stock, most with buy ratings and a consensus target price of 89.88, which implies about 14.4% upside from current levels.
Those valuation metrics are certainly eye-catching. Given that expensive valuation and the consolidation we're seeing, what's your view on the risk-reward here? Is this a buy-the-dip opportunity, or are we looking at a stock that's gotten ahead of itself?
That's the critical question, Robert, and honestly, the risk-reward here looks asymmetric to me, and not in a favourable way for new buyers at these levels. Yes, you've got 14% upside to analyst targets, but when you're trading at 595 times forward earnings and 25 times book value, you have virtually no margin for error. Any execution misstep, any launch failure, any delay in their Neutron rocket program, which is their next-generation medium-lift vehicle, could trigger a massive multiple compression. We've already seen the stock can drop 21% from its highs pretty quickly. The bull case here is solid. Don't get me wrong, they're approaching their 85th mission, which proves operational reliability in an industry where that's absolutely paramount. Their dual revenue stream from launches and higher margin space systems is attractive, and the overall space economy is expanding with growing demand for satellite constellations across communications, Earth observation, and defense applications. Their vertical integration from components all the way to complete spacecraft creates a competitive moat. But here's what concerns me. Poland Capital, a respected institutional investor, identified Rocket Lab as a detractor to their small mid-growth strategy performance in Q4 2024, which suggests recent underperformance versus benchmarks. The path to profitability remains unclear, and in a rising rate environment, or if we see rotation out of high multiple growth stocks, this could get hit hard. Competition is intensifying with SpaceX's rideshare program and other emerging launch providers, putting pressure on pricing. My take is this: if you're an aggressive growth investor with high risk tolerance and you believe in the long-term space economy thesis, you might consider positions around successful launch events or on further weakness. But for value-conscious investors or anyone looking for reasonable risk-reward, I'd wait for either meaningful multiple compression, maybe back toward that $50 to $60 range, or much clearer visibility on the path to sustained profitability. The stock's had an incredible run, and sometimes the best trade is to wait for a better entry point rather than chasing momentum at premium valuations.
That's a measured assessment. Let's move to crypto markets. Lizzie, what are the latest trends you're seeing in Bitcoin, Ethereum, and Solana heading into next week?